What if you didn't have to work past 40?
Not because you won the lottery, but because you got strategic with your money.
That's the early retirement plan we're building.
We're walking you through exactly what we're doing and in a way that you can copy for yourself.
From the numbers you need to how to get there to our 3-phase investing strategy that we're actually using. Plus an update on where we are in the process right now. So the first step is figuring out what we actually need at 40. We started with our needs, which would be our home and our home bills, which works out to around $50K in annual expenses right now, and we think will be pretty similar then. Then we also put about $12K towards groceries, which gives us a total of $62,000 when it comes to our needs. For our wants, we feel like we spend less than $2K a month combined right now. So we budgeted ourselves $3K a month for in our 40s, which would give that room for travel as well. So that puts us right at that 100K point. So it feels like a pretty good ballpark for us. One thing about us is we always lean on the ballparks instead of spending the time to be super specific, because things change, you learn more, and that number's probably not gonna be exact anyways. So if we want work to be optional by the time we're 40, that means that we need to be able to pull 100K from our investments each year in order to pay for our expenses. Now, this next part sounds more complicated than it is, but I'm gonna put it into simple terms for you. We have to figure out how much money we need in the stock market to be able to pull that 100K each year. The short answer is $2.5 million, but let's lay out how we got there. I want you to think of your investments like planting flowers. So you've got a new garden bed, you plant some flowers, and they grow themselves. By the time the next summer comes, you decide to cut a bouquet for your dining room. You cut those out. There's actually more growth than what you originally planted already. Maybe that bouquet you took is from the growth alone. And when you take that out, you don't really notice a missing chunk. It really grows and it continues to thrive on its own. That's like how it works to pull investments from the stock market. And the rule of thumb is if you pull about 4% of your investments each year, that gives you enough to pull that amount and still not really have it impact your current investments or the growth of it. If you want to learn more about the 4% rule and the FIRE concept, go ahead and click this video we previously made. So the question becomes, what is 100K 4% of? And the answer, you guessed it, is $2.5 million. Now, if you're like us, you can likely take that same $2.5 million, we've done the math for you, or if you're a single individual, feel free to go off 1.25, assuming you're comfortable living off 50K in expenses. If you know already that you expect to have higher expenses than us, or maybe you're going to live a little bit more frugally so that you can have less in expenses, all you have to do is take that future expense number, divide it by 4%, 0.04, and that's going to give you how much you need invested at your early retirement age in order to pull it off.
Now that we know how much we need invested by the time we're 40, we need to figure out how we're gonna get there. First, you have to figure out where you're starting from. That could be how much you currently have invested, or if you have some cash laying around that you plan to invest this year, you could throw in that number and use that as well. Knowing where you are starting at and where the finish line is, you can now figure out what the gap is, what's missing. And instinctively, you're probably just gonna wanna subtract where you're starting from your end goal, but it actually doesn't work like that. But luckily for us, compounding interest exists and you don't have to invest that whole number. So here's an easy way for you to figure out how much more you need to contribute in order for you to reach your goal. For this next part, you're gonna have to use the calculator that we have in the description below. So you're gonna go ahead and drop in your finish line number as $2.5 million or whatever your goal is. Drop in your starting number line. Let's say combined you have 500,000 invested already, congrats. Put the number of years until your ideal retirement age, and if you're like us, put 8 years because we wanna be retired by 40. Put the interest rate as 10% or 8% if you wanna be a little conservative. For us, we're gonna put 10. Put your compounding frequency as yearly, and once you click the calculate button, this will give you the number that you need to invest every month in order for you to hit your retirement number with your given timeline. So to get your annual number, you would just multiply that by 12, and I know what you're thinking, if this number seems crazy, stick with us. Phase 1 of our investment strategy may change your mind. And if it still seems crazy, we'll show you exactly what to do to make it more attainable.
So we have the future numbers that we need, we understand the gap and what we need to bridge that gap. Now we actually need a plan to put into action. So the way that these 3 phases are set up are really based on the percentage of where you are in relation to your end goal and the different focus that we have during those phases. Phase 1 is all the way from 0 to 40% of your goal. And if you're like us and using 2.5 million, that's gonna be until you reach your first million invested. Phase 1 is all about invest, invest, invest. It's about making as much as you can and contributing as much as you can. We're talking about taking on more clients than you would in the future, saying yes to more of the brand deals coming to your door, saying yes to more of the opportunities, maybe coaching a few more people than you would like to in the future, leaning in on the cash machine aspects of your business. This is one of those underlying things that has been so helpful to us, and I just really wish someone had given me this perspective when we were in that phase of our business. I spent so long stressing about how to build something more scalable, more sustainable in the long term, which is really important, and we'll touch on that further. But I think at that phase, us making as much as possible in high revenue, high profit businesses and having those high contributions really is such a major part of where we are today. We're obviously not recommending that you push yourself to burnout. I've been there and it is not fun. But what you really want to focus on is just thinking about what is sustainable in the current time frame and not in the long term. You don't have to do the scalable things now. We can be putting in that extra time of doing that extra exchange our time for money so that we can get those contributions really moving. As an example, for us, we actually contributed $567,000 in just a 3-year period. That was really that peak of phase 1 for us. We both were doing well in high cash businesses and making sure we were really focusing on those high contributions. Your investments during this stage could go 2 ways. One is really large monthly commitments. If you have a business where you have set revenue, maybe you have clients locked in for a year and you really know you have that stable money that's guaranteed coming in, you can base more of a larger monthly contribution off that information. But if you're like us, where your business is maybe doing a little bit more of this and the income is less predictable, you can set a smaller auto investment monthly, something that just feels comfortable. And then if you're doing your money check-ins every week like we like to do, that really keeps you in tune with your money, which means you can either adjust the auto deposits, or a lot of what we did is do these lump sum dumps. So whether it's at the end of the month or the end of the quarter, looking at how your revenue is doing compared to what you expected, and if you're able to really funnel that cash into your investments. That is a major part of how we were able to contribute that $567,000. We also tend to do really large lump sums at the end of the year when we have the full picture of how that year went and where we want to be going into the new year. This is a really great opportunity to siphon that off, funnel that cash, and really focus on that high revenue and high contributions for phase 1. So Josh mentioned earlier that if that number was really scaring you of what that calculator shot out, what you're going to do is you're going to go back to that calculator and you're either going to adjust that end number of how much you need invested at 40, you could lower that goal, or alternatively, you can put a longer time frame. So if you put 8 years, maybe you look at 10 to 12 or 15. Even if you lower your goal, that could just mean that at least half your expenses are covered at 40 and it feels like less pressure. Or if you really want that full coverage, maybe it is going to be extending the year.
You've hit your first $1 million invested, or 40% of your goal, and now you're ready to go to phase 2, diversify. This phase, you're going from 40% to 60% of your goal. And if you're using the same numbers as us, that is $1 million to $1.5 million invested. The best part is, you're halfway there. Congrats. You've become really good at funneling cash at this point, and thankfully, compounding interest is really doing its thing and really helping you speed up the process of getting to that investment goal. As your money continues to grow, now is the time where you might want to start considering diversifying into different investments. Diversifying could be investing into different ETFs in other industries, possibly switching from a robo-investor to a self-directed account. It could even be selecting individual stocks that you feel really confident in, or just some government bonds. From our experience, it wasn't one stock or one asset class that's made all the difference. Honestly, it's just been investing our money sooner, as fast as we could, to let compounding interest do its thing. Another avenue you could explore is real estate. We like to diversify in real estate because we don't want to solely depend on the stock market and we want to lower our risks a little bit. However, we choose to not count this as part of our $2.5 million investment goal. We consider real estate to be part of a longer term strategy, making it harder to use for early retirement. Diversifying does lower your risk, but don't forget, here you still want to focus a lot of your energy and time to just funneling cash to your contributions so that you can hit that retirement number faster.
At this point, you've got the momentum going and you're likely more diversified. Now this phase takes us from 60% to 100% of the goal. Your retirement number is more or less inevitable if you keep following the plan. So future you is looking pretty good. But current you, she needs some stability. This is what we informally call the don't f it up phase. But how do we make sure that we've already put in that work in phase 1 and 2? Our future's looking pretty good. How do we make sure that we are good from now until then? Both in feeling secure in that year to year, paying our bills, making sure you're still doing those contributions that you need, and just feeling good about the type of work that you do and the life that you're living. This phase is really about building that next chapter. So that could look like thinking about what would make you a more steady, recurring income. We mentioned earlier that it's okay to lean into those cash aspects. And maybe at this point, you've already started building in something more recurring and steady so that you can ease off of that. But if you haven't, this phase is really about doing that. So looking at what is going to be that stable recurring income from you, and ideally it's something that you would enjoy doing from this point until that early retirement year. This could look like shifting revenue streams, maybe releasing a new product, opening a membership, building your team. Or if you're kind of enjoying the way that you're trading your time for money and that relationship feels really good to you, you can keep the status quo. As long as you feel good about the plan, it's going to get you those contributions and you're covered until that early retirement phase.
And we can't forget about phase 4, the sprinkle phase. This is a phase where you can roll the dice a little bit more, take a little bit more risks because you're already set. You're 100% funded, work is optional, and yeah, you can go invest in crypto, you can go invest in a startup, or maybe buy an existing business. And the reason why we call it the sprinkle phase is because you could sprinkle these throughout the whole process. And as Mal mentioned earlier, if you find an opportunity that really aligns with you and that just makes sense with your given context, it's worth checking out. Go for it, right?
So where are we in the plan right now? As you know, our goal is to have $2.5 million invested by 40 in order to generate $100K in passive income each year to fund our life. Right now, we are done phase 1. We officially have $1 million in our stock portfolio, which feels crazy to say. We are out of that high revenue, high contribution phase, but we still have a minimum of $30K a year to invest over the next 8 years in order to hit that goal. For us, that feels manageable, which is kind of exciting, but if you know me and how I am with goals, I would rather get there faster and get it over with. It's really like a Band-Aid rip for me. I always choose to rip the Band-Aid. So we are aiming to invest probably double annually. We're going for $60K a year so that we can be done in 4 years. And if I'm being honest, I have a secret goal of pulling it off in 2 years. So I'll keep you posted on that. Now, we are technically in phase 2 right now, but I do have a confession to make. We do already own real estate. And we didn't bring it up earlier in this video because for us, it's actually not part of that early retirement plan as Josh hinted at earlier. To be honest, we invested in real estate early on because we knew that we wouldn't have a traditional pension for a traditional retirement age when we get older as 2 self-employed individuals. We've talked about a lot of different things with these properties. We've talked about selling them so that we could buy our dream home eventually and be mortgage free. We've talked about keeping them as downsize options so that we could house our parents as they continue to get older. And we've also thought about keeping them as assets, keeping long-term tenants in them, and potentially having some passive income as we pay down those debts. Our phase 2, when it comes to diversification, looks like diversifying the stocks and ETFs that we have. We're back into a learning phase of how much should we change it up? Should we have more global options? Should we have more specific stocks? Maybe some different ETFs? What else can we learn to improve our growth and also lower our risk? We're also sneaking a little bit into phase 3 because we're feeling really good and on track. We're focusing on using this year to really start building that transition of what do we want to be doing work-wise for the next 7 to 8 years. What's the thing we really want to build and what's the legacy we really want to have? So part of that is making these videos for you right now.
Okay, so we walked you through a lot of numbers, and you may want to rewatch this in a few days or even right now to make sure you fully process the plan. For more unconventional money conversations, check out these videos and don't forget to subscribe.